Hey traders, welcome back to Trade Empire. In this video, we will explain the concept of supply and demand zones, and explain that how they differ from traditional support and resistance levels. And we will teach you the best technique to identify high-quality supply and demand areas by using smart money concepts. And we will explain these following topics briefly. So, if that's something you are interested in, make sure to hit the like button to show us your support and subscribe the channel for more trading videos. See you after intro. So, let's start with support and resistance. What is support and resistance? Support and resistance are the zones where price has reacted in past or may react again in future. Here on the chart, we can see that first price pushed down, hit this area, and then reverse. And we call this area support zone. It indicates that the buyers have opened their long positions and sellers have closed their sell positions. And after that, price pushed up to this area, hit and reverse. And we call this area as resistance zone. It indicates that for some reason, the sellers have opened their short positions and buyers have closed their long positions. This dual activity by sellers and buyers is what makes the price reverse from these areas. Next, why do we mark them on charts? The first reason to mark them on chart is because the levels that price reacted before have a high chance of getting rejected again. So when price approached these levels, we closely observe the price action and candles behavior in that zone for possible rejection. This helps us setting our take profit targets, and especially if they are higher time frame key levels, because we all know that a small reaction in bigger time frame can be a major trend change in lower time frame. Number 2, identifying the market direction. As when the price break through resistance level, it indicates that the buyers are more powerful than sellers, and a bullish trend will continue. Similarly, breaking below a support level shows sellers' strength. So, we want to trade with the dominant trend, as identifying the direction is the first thing we do when we open the chart. What is supply and demand area? Supply and demand areas forms on the chart when smart money enters the market, causing a significant price movement. We cannot refer to it as a valid demand or supply zone when we see rejections with multiple small candles. A valid demand zone forms on the chart when we have large candles with inefficiency. It indicates aggressive buying pressure. And these momentum candles tells us that the big players, like banks and institutions, are in the market. And a valid supply zone forms on the chart when we have big bearish candles with inefficiency. But here's a question: how do we measure the aggressiveness of a price movement? We use fair value gaps to measure the aggressiveness of a price movement. A fair value gap is the space between 3 consecutive candles. The bigger the gap will be, the more aggressive the movement will be considered. And a demand or supply zone with fair value gap candles have a higher chance to get reacted by price. Fair value gap is a sign of imbalance between the buyers and sellers in the market, which indicates entering a large amount of money in the market. And market revisits these areas to fill the order left behind and restore the balance in price. How to mark supply and demand zones on the chart. Before we mark a demand zone, first we have to identify the fair value gap and break of structure on the chart. Once we find a move with both of these, we will mark our demand zone like this. We draw a zone from the high to the low of the last candle of this move that created this break of structure and fair value gap. And we believe that the decisions were made during this candle. And price will again tap this area to fill the gap and to pick the remaining orders. Same concept applies for the bearish scenario. We first identify the fair value gaps and break of structures. Then we can mark our supply zone like this. It can be a last candle of that wave which created fair value gap and mainly break of structure, or it can be multiple candles in that zone. Because we treat supply and demand levels as areas, not a specific price. Order blocks, order flows, and consolidation areas. Order blocks are optimized in supply and demand zones. Here on the chart, we have this aggressive buying pressure, with clear fair value gaps leading to a break of structure. And this is the last opposite color candle we marked as our demand zone, as we believe that the buying decisions were made during this candle. Now, we can notice one more thing here. We can see that how price grabs the liquidity below this candle before taking off. But here's a question. What will be the safest place to set our stop loss if we place a buy limit order at this order block? The answer is simple. We will set our stop loss below this wick, from where the movement has started. And we will also add this area into our order block. Then we will wait for the price to come back and fill the gap, and tap into this area to fill the remaining orders. And we will find some trading opportunities then to go long. And sometimes order block forms in the middle of a heavy movement with opposite candle color. And we know that the big players, like banks and institutions, love to use these zones to fill their remaining orders at low price. So if we have these types of order blocks on our chart, we can also find trading opportunities there. And these order blocks gives us great reward with very low risk and small stop loss. Next we have the order flows. Order flow is an area where the buying or selling pressure was building up before an aggressive movement in the market. A bullish order flow is the last bearish pressure was present before the aggressive move. And a bearish order flow is where the last bullish pressure was present before the aggressive bearish move. As order flows areas can also be considered as key supply and demand and smart money concepts. Now look at this example. Here we have this move that created fair value gaps and leading to a break of structure to the upside. And these two candles are the last bearish movement before the aggressive bullish move. So we highlighted them as our order flow area. And we also have this order block zone here, as the order flow area is a large zone and usually contains half of the order block within itself. Next we have the consolidation area. A consolidation area occurs when the buyers and sellers are not strong or interested enough to move the market into a trending position, and then price trapped within a box range, and we call it sideways trend. This situation persists as liquidity accumulates, eventually leading the price to break through a structure in one direction. It can be upside breakout, or it can be downside. After that, the consolidation area becomes a key supply or demand zone for traders. But we still need some imbalance before we consider this area as a valid supply or demand zone. Here in this example, we can see that price is in a consolidation phase. And we do not trade when price is consolidating, so we will wait for a breakout to any side. And after price breaks through the consolidation area to the downside, it comes back and give us an opportunity to go short. All we have to do is to find any entry reason in this consolidation box when price comes back after breakout. Next we have the confirmation and entry setups. In this section of the video, we will teach you the best techniques to trade the supply and demand zones and execute your trade at a better price. First, we always look for a trade with at least 1:2 risk and reward ratio before reaching our first target. As here price breaks through a structure and left a valid order block behind. So if we set our buy order at this order block, then our first target will be this higher high. So, we will set our order at this order block and make sure that it has 1:2 risk and reward ratio. And we got a winning trade here, but if your order block is a large zone, then you can set your stop a bit below the ending. However, let me show you some of our best entry techniques if your order block or entry area is a large zone. So instead of placing our order at the top of zone, we will set it in the middle of the zone and set our stop loss below it. By doing this, we can cut our stop by a significant number of pips. The main psychology behind this entry technique is optimizing our supply and demand zone, and also our entry and exit points. The next technique is to wait for the confirmation in lower time frame, which we do most of the time, because no matter how good is your trading zone, there's always a chance for the price to ignore your zone and break through it. But here's an important point: when our trading zone is a large area, then we need more confirmations to execute our trades, because we know that market loves to take out the early buyers and sellers. Sometimes when price enters a large demand or supply zone, it gives us many false signals before a valid reversal occurs, and it can lead us to lose many trades. That's why we have to look for double confirmation even after a change of character. Let me teach you with an example. Here we can see that we are in a downtrend, as price is continuously breaking through the structures. But then, price creates a change of character, as it violates the previous market structure, and it is giving us a signal for a possible reversal in market. But in case of a false signal, the market will ignore our demand zone, and it will break through it, and will continue its downtrend. That's why we will be looking for a double confirmation to execute our trade. We will wait for the price to make another change of character, and also a break of structure to upside. So, when a change of character followed by a break of structure, it gives us double confirmation that the trend has been changed. Let me teach you on a real chart. Here on the euro-dollar for our chart, we can see that market is in a downtrend. And after this recent break of structure, we have this valid order block. Now, we will wait for the price to tap into the order block zone. And after price taps into our higher time frame order block zone, we know that this wave will be an uptrend in lower time frame. So, we will move to 15 minutes now and check for double confirmation. Here on 15 minutes chart, we can notice this short-term uptrend here, as price is in our order block zone, but we don't know that it will reverse from it, or it will break through it, so we will wait for a change of character, and also a break of structure for double confirmation. And here we can see that price reversed from our order block or supply zone. And now we have a change of character and also a break of structure to the downside. If we set our order at this order block in for our time frame, we will still be in profit, but this will not happen all the time. Many times price gives us false signals, so to increase your winning ratio, you should always use multi-time frames and double confirmations. By doing this, you will get less trades, but your accuracy of winning will probably increase. So now we have this latest supply zone, and we will set our pending sell order just a couple of pips below this supply. Stop loss will be above this supply, and for take profit, we can target the next key level of higher time frame. And you can see, our stop loss is much smaller now. And finally, we have a winning trade with great reward and very low risk. So always be patient and wait for your setup to execute any trade. So guys, that's all for today. If you have enjoyed the video, make sure to leave a like and subscribe the channel. Good luck for your trading journey.